Growth and inflation are two fundamental economic forces. They are interconnected and influence investment strategies. Growth refers to the increase in the production of goods and services in an economy. Inflation, on the other hand, is the rate at which prices for goods and services rise over time. Understanding the interplay between growth and inflation is crucial for investors. It helps them make informed decisions about asset allocation. Different economic scenarios favor different asset classes. Recognizing these patterns can significantly impact investment returns. When both growth and inflation are lower than expected, bonds become an attractive investment option. Bonds are debt securities that represent a loan made by an investor to a borrower. In a low-growth, low-inflation environment, interest rates tend to fall. This makes existing bonds with higher coupon rates more valuable. Investors are drawn to the relative safety and stability of bonds during such times. Government bonds in particular are seen as safe haven assets. They offer a steady stream of income and capital preservation. Corporate bonds, while riskier, can also provide higher yields compared to stocks. However, when growth and inflation are higher than anticipated, bonds become less favorable. Rising inflation erodes the purchasing power of fixed income payments. This means that the interest payments received from bonds buy fewer goods and services over time. As a result, bond prices tend to decline. Investors become wary of bonds in such scenarios. They seek alternative investments that offer better protection against inflation. Stocks, commodities and real estate often become more appealing. These assets have the potential to outpace inflation and generate higher returns. Section 4. Inflation hedges, commodities, gold, and inflation-indexed bonds. When inflation is a concern, certain assets emerge as potential hedges. Commodities such as oil, gold, and agricultural products often rise in price during inflationary periods. Gold in particular has historically been viewed as a safe haven asset. Inflation-indexed bonds are another option. These bonds adjust their principal and interest payments based on changes in inflation. This feature helps protect investors' purchasing power. Section 5. Stocks, riding the wave of high growth and low inflation. Stocks tend to perform well in an environment of high growth and low inflation. When the economy is expanding, companies often experience increased profits and revenue. This translates into higher stock prices. Low inflation supports corporate earnings and keeps interest rates in check. Investors are drawn to the potential for capital appreciation and dividend income that stocks offer during such periods. Growth stocks, in particular, which are companies in industries with high growth potential, are favored. However, it's essential to note that stock markets can be volatile and investments carry inherent risks. Section 6. Conclusion. Navigating the investment landscape with economic insights. Understanding the relationship between growth, inflation, and investment choices is paramount for success. By carefully analyzing economic indicators and anticipating market trends, investors can make informed decisions. Diversification across different asset classes is crucial to mitigate risks and optimize returns. Remember that investment decisions should always be tailored to individual financial goals, risk tolerance, and time horizon. Seeking advice from a qualified financial advisor is highly recommended. By staying informed and adapting to changing economic conditions, investors can navigate the investment landscape with greater confidence.